First. Okay. Okay, there we go. So first, I just want to start. We have about six on there. I'm just interested where everybody's from. So I'm always curious. I know we spoke a little bit with Ans. She's from Norway. I just got a feeling we're covering all the bases out everywhere in the world today. You know, we couldn't have been any farther from Norway. But just to introduce yourselves, and be
Yeah,
interested. Roxanne,
yeah, Roxanne.
where are you from? Do you have a startup?
Hi, yeah, I'm based in the UK in
Oh,
England, and the startup business is real estate, so a property business. So yeah, at the stage of just really needing some investment, and at the early stages of doing a pitch deck. So this event has come at the right time, really, to get that extra guidance. Yeah.
oh, great. You know, so the reason why I'm asking too is because I have a lot of stories to tell to prove some of the points and things in my in my deck or my presentation. So it helps me. So what story should I use to illustrate in some parts? So that's another reason to ask. But thank you, Roxanne. Thank you for joining us today. And let's see. So Myson, am I saying right?
Yeah, you're saying it right, Dave. I'm actually based in Bali. I don't
Oh,
own
nice.
any startup, but I'm working for a startup,
Uh-huh.
Slash.
Okay.
So,
Okay, you with
yeah,
Slash with Andres.
yeah.
Yeah.
And yeah, I just want to know how it is uh, to present to investors. Who knows? I'll have my own startup in the future.
Well, hopefully you do. Hopefully that would be wonderful. Yeah. Yeah.
Thank you.
And that's a great place to start your entrepreneurial journey working with
Right.
Andres. He's had a few ventures in his day.
Indeed.
So okay. Well, excellent. Thank you. Thank you for joining. So
Pleasure.
so we have a Dylan.
Yes.
Illinois? Yes.
But I'm actually just getting ready to start on possibly a startup for Southeast Asia. So I'm trying to learn from what the experts like yourself have got to share, and then we take it from there.
Okay, great. Do any particular industry, any kind of
Specifically with regards to real estate.
okay, okay. All
Yeah.
right, very good. Okay. So, and this is a hot market for it here. Okay. It's starting to pick up again. This past year has been terrible for real estate startups, but now deals are going to start getting through again. So this is might be good timing. The best time to start a startup is during times like this when it's really difficult because it gives you some runway where you're not jumping in and really going against competitors. And also for startups, if you already started, it's a great time where you can actually work on improving your product and doing the development work you need and refining your business model because it's hard to do the marketing and gain customers at this time. So a lot of startups are wisely, fixing everything up as much as they can. So when things open up again, they're in even better position. So this is actually a good time to start a startup. So happy to hear we have a few that are thinking about it. And I'll keep that in mind. So right now I'm going to share my screen. I'm going to put up my presentation deck. Let's see. Just give me a few seconds here. I gotta open up right here, Zoom. There we go. Okay, everybody see the deck?
Yes. All
Okay,
good.
okay, very good. Um, so 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 I'll just give just a personal background, just briefly. So right now I'm based in Phnom Penh, Cambodia. So I've been in Southeast Asia since 2008. Up through beginning of last year, I was in Bangkok, Thailand. So in 2008, I was part of the community building, the startup community in Thailand. So it started around 2008, and so I've been part of that. Beginning of last year, I moved to on the urging of some friends that already relocated here. They've got me interested in Cambodia because there's a new startup community here. So my expertise is in the startup community building, and so my background in the entrepreneurial field is I pretty much, if you think about the 7 stakeholders, public space and the startup organizations and investments, entrepreneurs, schools, I've kind of played, at some point, some place in one of them, in one of those. So, but right now I'm entrepreneur in residence at Mekong Strategic Partners here in Cambodia. So Mekong Strategic Partners is the general partner that manages the SATF fund. The SATF fund is a $5 million venture capital fund. And the investors is Smart Axiata, which is the biggest telecom in Cambodia, and Forte Insurance, which is the biggest local insurance company in Cambodia. And we invest in early stage startups. We currently have 10 startups in the portfolio. And my job is basically to advise the startups with strategic advice, financial, help with fundraising, make sure the business models are scalable, marketing, operations, pretty much cover everything. So that's my day job. At night or on the weekends, I teach at a local university called National University of Management. So I lecture on business model innovation and strategy. I also stay involved with 2 international organizations. One is International Telecommunications Union, which is part of the UN. So I'm an Asia Pacific regional and innovation expert. So I do a few things for them. I will go to different places in the world and do workshops, like 4 or 5 day workshops on stakeholder collaboration and digital transformation. So I was in the last 2 recent trips. I was in Busan, South Korea, and Oslo, Norway. So that's so I've worked with them in that capacity. I'm also a national expert in global jurist for the World Summit Awards, which is the largest social impact competition in the world. It's 187 countries this year, and it's a year-long process. At the end, there's a global conference in some country of the world. And usually the prime minister of that country opens the conference. It's a big deal, it's the I get to see every year. I have the privilege to see all the top social impact ventures in the world, literally well over 1,300 applicants every year, but I'm also a national expert. So for more than since 2014, I actually set up every country has a nomination committee, a WSA nomination committee. And in 2013, I went to the annual conference in Colombo, Sri Lanka, and as a finals judge and a keynote speaker. And I was bragging about how great all of our social impact startups we have in Thailand. And one of the judges called me out and said, "Why isn't any of them here?" So, and I find out that we don't have a national committee. So I came back to Thailand in 2014, established one. So I've been busy with that. And then this past year, with my relocation to Cambodia, I transferred and became a national expert here. And we're going to run our first nomination campaign in Cambodia to pick the top social impact ventures in 8 different SDG categories. So I'm involved with those 2 international organizations. I'm also an author. So these are the 3 books that I've authored. The first 2 books are mostly for entrepreneurs. The first book is a book that I just used for mentoring, that the way I mentor startups. So this book was published back in 2013 by John Wiley, publishers out of Singapore. And in the last 2 books, I self-published, Bootstrapping Strategies for Tech Startups, and my last book, Building Startup Ecosystems. So those are my 3 full-length books. So just going to get into what we're going to do today. So there's what I'm going to, first we start with my actual presentation, where I'm going to go over what an investor deck is, all the different slides, of the investor deck. What's the objective of each one? What kind of content you put in there, and then the correct progression, which is very important. How you order the slides as well. And then once that presentation's over, there'll be a little bit of Q&A, and then I'll go into, I have a sample investor deck, so you all get an idea of what one actually looks like and how one's constructed. The most important thing, and what you might want to take notes on, is when I go over the objective of a slide. That's really important because everybody's venture is different. So you can't, like, take any of these investor decks or anything like this as a template, but what's important is the type of slide, and what objective you're trying to achieve with that slide, because you have to customize it for your particular startup. So it's really important to follow, okay, what's the objective of the slide, really understanding that, because when you do make your investor deck, it's going to be for your company. So that's very important. Most people, I see presentations, they do investor decks all the time. You see it online. It doesn't explain the objective. So sometimes things are lost in translation, or people, it might be the content is good, and showing good investor decks, but it's not telling the whole story. So I like to talk about objectives of the slide. So let's start with, what is an investor deck? So I put pitch deck in parentheses because sometimes people refer an investor deck as a pitch deck. They're actually not quite the same. So a pitch deck is a condensed version of an investor deck. An investor deck is about 20 to 22 slides, and this is what I'm presenting today. And this is a deck that if an investor was interested, they might say, okay, let me see your investor deck. So this is the deck that you're going to send them. A pitch deck is a condensed version of an investor deck, because a pitch deck is something that, let's say if you go into a pitch event and you have 6 minutes to present your company, you're not going to be able to go through 22 slides. So a pitch deck is kind of a condensed version, but you don't start off making a pitch deck. You do the investor deck first and then condense it into a pitch deck. So it's kind of like, the business plan, is a long business plan is maybe 20, 30 pages long. Then you have an executive summary that's 2 pages. It's just a condensed version. So that's we'll see. So what is the objective of the deck, of an investor deck? So one is you want to show the investors that you have an ideal problem solution fit. So problem is the problem of the target market that you're trying to address, and the solution is basically your product. How are you addressing that problem? So you want to objective investor deck is to be able to show the investors, yeah, we have a good problem solution fit. Here's the problem, and we have a solution for it, and this is how it addresses it effectively. And then the next objective is superior value proposition for target customers. So you have to show how the customers derive value from your solution. So it might be just beyond just solving that actual problem. There might be some other benefits that are part of it. But you want to show in the value proposition all the possible ways your solution can benefit your target market. And a target market could be many different customer segments as well. Many different customer segments can derive different values from. And then you also want to show that you actually have an optimal business model. So you could have a product that delivers high value to your target market, but can you make a sustainable business out of it? So you have to have a business model that shows that, yeah, we can make money on this too, and we can survive. So picking the right business model you're showing in the deck. Another thing is, a lot of investors, they might see up to 100 investor decks a month, and likely they've probably seen 3 or 4 in the past week that might be in the same industry as you, trying to do this, comparable startups trying to do the same thing. You want to be able to show that you have a unique value proposition, that you're different from the competition, that you have certain things that give you a competitive advantage, back in the day, a long time ago, it was for startups, it was about technology, right? We're just utilizing more advanced technology. Nowadays, that's not the case. A lot of development's open source. I mean, it's not even, so the innovation comes in the type of business model you have, the way you're going to use the channels to reach your customers, all kinds of things that are non-technical. That's where most of the innovation for startups is being generated nowadays, not necessarily the technology. And then display of RMFs to reduce perceived investor risk. So RMF is risk mitigating factor. So this is a term that I came up with in my first book. I give a list of what I consider risk mitigating factors. So investors, everybody likes to show investors the upside of your product. So if you invest in us, this is the upside. This is the type of returns on investment. This is how much money we're going to make, and things like that. But investors, they consider risk just as much, even though a lot of them won't say it. But risk is a really important factor in their investment decision. And so there's certain characteristics of your startup that might be a risk mitigating factor, that might reduce the perceived risk of investing in your company. And so that's something that you want to highlight as well, and in the investor deck. So that's kind of like what the investor deck is trying to do, is trying to drive home these points to the investors. Another thing that's really important before we go into each individual slide and the objectives of each is it needs to be a narrative flow to your deck. So there's two reasons why order is really important in the investor deck. One is this narrative flow that somebody can just go right through the deck and it sounds like a story to them. People remember stories better, so I think a particularly really good skill to have as an entrepreneur is storytelling. So when I try to set up Founder Academy or try to get people to come in and speak, whether it's to a class or to a group of entrepreneurs, I always try to find a good storyteller, someone who's, whether they're certified or not, but storytelling is a really important thing for a very important skill for an entrepreneur to have, because that's how you can set yourself up, set yourself apart from other startups, and how you can stay in people's minds. And so narrative flow is really important. When I look at an investor deck, I do two reads. The first read, I just go right through the deck and see if it's telling me a story, if it's something compelling. And then the second read, I'll go and slow it down and actually look at each slide and look at the content and really judge, whether do these people have a good business model? Does this make sense? Is the customer journey easy enough? Things at the individual level, micro level, but at the macro level, I read that deck right through first and see if it's telling me a story, because that's could be the most compelling thing about your business. So the second reason why to have the order so important, the way you order your slides, is that you want to make sure that whatever you're trying to convey in a slide, that proper context has been established before you say that. For example, when you get to your competitive advantage slide, it's not going to mean too much to an investor if you haven't talked about the competitive environment yet. It's hard to talk about value proposition of your target market if you haven't done the target market slide where you actually say who your target market is. So there's practical reasons why to make sure that the order is correct. So while you're preparing your investor deck, you periodically have to just run through it, or have somebody else run through it. Just go through it and make sure it makes sense to them. Sometimes it's better to have another set of eyes do it, because it's harder for you yourself to find these discrepancies or uneven flow if you're the one creating it, because you have this kind of like built-in bias on it. So it's always good to have a second set of eyes on there to go through it. And so narrative flow is really important. Okay, now we're going to go into the different types of slides in the investor deck. And I have here the 22 different slides in the preferred order. So this is a order of slides in an investor deck. So this is not the be all. This is not, okay, if you don't do it exactly this way, it's not going to work. This is an order that does work, but you can have many other orders that'll work too. And for every startup, you might exclude one or two of these slides or a few of these slides, and you might add a few of these slides. So it's not, in stone, but this is a relatively good guidance, and those startups that create a deck in this fashion usually are okay. They don't have any problems. So those are the 22 slides. We're going to go over each one and kind of point out what it needs to accomplish. So the first one is the first slide is just a business summary. So it's a catchy, this is like equivalent to your elevator pitch. You have 20-30 seconds to explain your business to somebody. So we are a software as a service business freight tech startup solving this problem for these people. We are on an online marketplace for handicrafts, local handicrafts. It could be 3 or 4 sentences, but just something that you summarize the business where you are. Where usually you're basically covering a few things. You're saying, okay, this is the business model, like software as a service. This is the type of company we're an online marketplace. We're freight tech. We're in freight tech, or we're in the different industry that you're in, and then maybe a mention of your specific target market. And so these are just a basic business summary. It's just a short paragraph that summarizes your business. And then the second slide is the problem slide. So the problem slide is you're listing the problems of your target market that you're trying to address. So examples might be our clients, customers. It might be difficult for them to manage inventory because manufacturers have no easy way to sell directly. Farmers suffer from cash flow between purchase of seed and sale of produce. You're just listing problems that your target market has, and so it's that simple. A lot of times people, especially working with people who try to do lean canvas, I put the problem column in the lean canvas, and they put down the problems of their actual startup. We have competition and stuff like that. No, the problem is about, this slide is about the problems your customer is facing, and you want to list the problems that you are going to address with your solution, which is the next slide. So the solution is basically describing the products or services that you have on offer, and you're going to match that with the problems you just listed. So you have to have the first 2 slides is the problem solution slide, the problem solution slides, because your rest of your deck won't mean much unless you state that hypothesis. This is the problem we're trying to solve. This is how we're solving it. Then everything after that will make sense. So this is why after the business summary, these are the first 2 in your deck. It's setting everything else up so the investors understand what it is. And this is a great opportunity. The first 3 slides in particular is lends itself very well to be a beginning of a story. So here's a chance for you not just to give a description of your business, but you can have a little bit of narrative, especially during the Q&A, or even put in a sense like, I started because I saw this problem. My grandmother had this problem, or at work we faced this problem. So we come up with a solution. So a lot of tech startups start that way, where a founder actually faced this problem or this dilemma. So founder observed it or experienced it, and that's how a lot of startups are started. So this is think about it, this is the opening chapter for a story. The next one is the what we call the how it works slide. It could be also called the customer journey slide. So what you want to do here is you kind of want to talk about, okay, so here's our solution. So we already mentioned the solution. This is what the customer has to do to utilize our solution. So you go right from, okay, we have to sign up. Do they just hit a subscription button? Do they have to call somebody on your staff and get help with setting things up? Do they first complete a self-assessment tool? I mean, what is the customer journey all the way to now they're onboarded, they're using your service. They're a paid customer and they're using your service. So that customer journey between that point and that point, you want to describe it in some detail right through there. So usually this slide, you'll see it's kind of like the customer journey can be illustrated too, right? And step-by-step process. So many entrepreneurs do that for this slide, where they just make it more of an illustration. The next slide is the target market. So target market is the customers you're trying to help. And it's usually expressed in like 3 different levels. You know, you have the immediate market, target market that you're trying to serve. So that basically is the market that you can reach given your immediate marketing channels that you want to go through. You know, so maybe your product can serve 4 or 5 different customer segments and deliver value, but the more narrow definition of that target market is just the target market you plan on directly trying to reach, right? And then another one, the next step up, the second one is the service addressable market. So this is the market where maybe you're not directly targeting, but they can conceivably, you know, find out about your product and derive value from it. You know, so maybe you have this product where you're only targeting your home city or your home country, but it's online. So people outside the country in your target market can benefit from it too. You're just not targeting them. You're not trying to reach out to them. And then you have the total addressable market, TAM. So this is a market where, you know, let's say if you had limitless marketing expense and you can reach everyone that could benefit from it. That's the market. That's the third rung. And so usually on this slide, people actually used 3 concentric circles connected and show how that's done. And they mention maybe the customer markets or the geography, you know, how they define each of those market segments. So the next one then is the market opportunity. So we have here the share of market, the service addressable market, and a total addressable market. So in the previous slide, you mentioned the target market, the different customer segments, and then here you break it down. This is more of the illustration with the 3 different concentric circles. The next one is, now that the investors know what market you're targeting, okay, how do you intend to derive revenue from them? You know, how are you going to deliver it to the target market? So for example, you have the type of business model. Is it platform based? Is it software as a service? Or are you just charging transaction fees like a marketplace? Do you have to charge, you know, onboarding fees? Maybe there's some customization work that'd be done at the beginning, you know. So this is just basically your business model. You know, how are you going to charge them? What are your revenue lines look like? So this is the business model side. And whatever you have on here has to match basically your pro forma financial statements. If you think about pro forma financials, your income statement, your expectations, your projections, you want to look at the revenue lines on your pro forma income statement. and make sure you include all the revenue lines here in the business model. So maybe you have ad revenue, maybe you have, maybe your primary revenue sources, if you're online marketplace, you charge transaction fees, you get a percentage of each transaction, but you might have also make ad fees, you might also make money on premium listings, all kinds of type of things. So maybe you offer some premium features that you'll charge extra. Let's say if you have a subscription service, you charge $50 a month, but if they want premium feature, somebody can pay extra. So all the different things you can have in your business model is presented here. And so once the business model has been established, now you can talk about the value proposition. So now that in the solution slide, the previous solution side, you said this is our product, and in the business model side this is how we charge them for use of this product. And you also already know the problem, what they're facing. So now you can do a value proposition where you're showing them, okay, by helping them address this problem with the said solution, and given that we're charging them this much, or we're charging them in this manner, this is the value proposition that we bring in. And so an important thing that's really important is that value proposition, it not only, when I say bigger is not always better, I bring this up in my first book, and I use the example of my first startup that I had in the States back in 1995. I had a digital media startup. We had digital taxi top signage, LED backlit, which was a big deal back in 1995. We had a competitor from Israel. So this was in the US, and our first market was New York City. And we had a competitor, Israeli competitor. They had raised like $12 million, and they were competing directly with us because they had a digital taxi top sign, but they was LCD lighting. And at first we decided we're going to go, toe to toe with them. We're going to see who makes the best sign, who has the most superior sign. So we're trying to figure out what, who's going to have the most bells and whistles, right? And then at one point we decided that, we found out from market analysis that no matter, there was all these features that are extra that didn't really, we couldn't get extra money for. So basically we found out in the marketplace, no matter what bells and whistles you have, you can only charge up to about $300 a month per sign for the ad revenue. You're not going to get higher than that. And then from that, we looked back and said, okay, what are the features that actually the customers derive value from? Because there's certain different, features, right? Some of them are just kind of like wow features to impress that, the client could probably do without, and then there's other features that, this is really what the customer needs, so we concentrated on just those features. So we scaled down our signage, and not try to compete with them, trying to win a science contest or something. So they beat us to the market. They had far more resources than we did. They got to the market 6 months before we did. Because they had all these bells and whistles, their sign cost $18,000. Our sign costs $6,000. Both our signs, when we launched, we had the same revenue per month per sign as they did, about $300. And within a year, they were bankrupt. They couldn't stay with us because we just had a better product. I mean, for the same revenue for our customers, they could buy our sign at $6,000 as opposed to $18,000. So this was well before the lean process and everything. This is mid-90s, but this was kind of like a lean experiment we kind of stumbled into, and we realized that that's you have to really look at measuring the true value. What is the value? Identify their actual values that the customer is getting, and stick to that. And that a better sign doesn't mean a better product or a better business. And so that's where you want to be in a value proposition. So value proposition, if we did a value proposition slide back then, that was before really investor decks. But if I did a value proposition sign for that business, I would have had us in the middle. I would have showed that, here are more far superior feature signs with better features and everything like that, but here's the cost. And then I could go below us and say, here's some cheap signage that's non-digital, it costs far less, but it doesn't, the lifetime, the operating life of the signs are shorter, and you make less per month. And so our sign was the best value sign. We weren't the cheapest sign, and we weren't the most expensive sign, but we optimized the value for the customer, because given the cost of our sign, we delivered optimal value for the customer. So that's really important to understand in the value proposition. You don't necessarily have to be the most expensive, the fanciest, or the cheapest. It's just delivering the best value for your customer. So that's really important. And so this is a very important slide that you want to get right, and it really can differentiate you from the others. And this is a slide I think investors, really one of the top slides that really investors look at. So that's really important. So next, now that you've established the value proposition, now how are you going to market your product? So what sales channels, marketing channels are you going to go through? So if you're a business to business, a B2B startup, you're most likely going to be direct marketing. You're not might not be as effective if you go on social media and do offline bulletin board ads. You might have to actually hire a biz dev team that will directly engage with prospective customers. If you're an online marketplace, that probably will not be very cost effective to do that. Try to use find directly engage with possibly hundreds of thousands of potential customers. You're going to want to be able to use online marketing channels and things like that. So it depends on your company and your business model. How do we reach out to them? What marketing channels we're going to use? And so this is a slide that kind of summarizes what your marketing strategy is. How you going to go out to that target market, given your target market and the value proposition that you provide, and the revenue, the business model that you have. What's the most important, most proper marketing plan? So then you have competition. So now that you have your market plan out there, you want to go out there and go after customers. There's competition that's maybe going after those same customers. So how can you differentiate yourself? So your competition might be decided to do the similar marketing plan, because that's the best, that's the optimal sales channels to go after your similar clientele. How do you better than them? Is it in the value proposition? Is it what is the value proposition that you have? And so this is where here on the competition slide, you want to list both direct and indirect competitors. So direct competitors, or competitors that have a similar business model to you. So competitors in general, it's defined as somebody going after your customers, or this is an alternative to you for your customers, your target market. So a direct competitor is someone that's actively going after your customers with a similar business model. Okay, they're your direct competitors. There might be a startup that does the exact same thing, offering the exact same thing as you are. Okay, how do you compare to that competition? And then there's more indirect competition. Okay, so this is indirect competition. Might not necessarily be a startup or a company that has the same business model of you, but to address the problem, your customer, it's an alternative to you, as far as addressing that particular problem that you define. For example, if you're a cloud accounting software startup, and you have 2 other cloud accounting startups in your market. Those are direct competitors. However, an indirect competitor might be 0. It might be bigger companies, Excel. It could be, a bigger company's just product. So that's an alternative. So your target market that you identified, maybe they're primarily using Excel, and that's kind of, you think that's kind of, outdated. And so you're trying to upsell the target customer and using something a little bit more sophisticated like your software. So Excel would be the indirect competitor because it serves as an alternative to your solutions. But might not have the same business model. So you want to list, and then the best way to do this, almost, I would say probably 80–90% of the time, startup is doing this competition slide. They're creating a competition matrix. So what they do is, they can do it in 2 different ways. One is you could do an axis, a chart that has a vertical axis and a horizontal axis. And in the vertical axis, you list yourself and your direct and indirect competitors. And then on the horizontal axis, you have a list of different features or characteristics. And then in the chart, you're showing, you might be saying, okay, like checks, like, so for your company, all 6 or 7 columns are checked off. Yes, yes, yes. And then your other competitors, yes, no, yes, no. And so you can do it that way. Or another way to do it is they have a matrix where you have a quadrant, you have 4 quadrants, and you have 2 primary features. One is a horizontal axis, one's a vertical axis, and then you place your company and your competitors within one of those quadrangles. So those are the 2 of the most common type of competition illustrations to do for this slide. And those are a lot more effective to do that than try to write it out in text. Now with the competition slide, now that you've identified your competition, now you're going to have a slide that is competitive advantage. So and this could be simply a summary of what the illustration is in the previous slide. So you can actually look at your slide 11, your competition slide, and say, you know what, this is what we have on our competitors. We're doing something that no one else is doing, so we're going to mention that. Everybody's doing something that we're doing, but we're doing at a fraction of a cost or a fraction of the time. Or here's a combination that we only do, that no one else does, and it's an important combination that is, and in combination, the customers derive a lot of value from. So basically, the competitive advantage slide is just showing how, just basically summarizing your advantages from the previous slide. Also on the competitive advantage slide, you can also add things that have nothing to do with the competitors, vis-a-vis the competitors. It might be you're uniquely qualified to deliver the product. You have the right connections. You have backside protection, which means it's protections against competitors. So let's say you're in a regulatory environment and you have certain licenses that maybe the others don't, or if they want to compete with you, they have to get some kind of approval or some kind of concession. Maybe you have a captive audience, you have exclusivity deals with some strategic partners where you have access to this captive audience and your competitors don't. Maybe your team is just uniquely qualified to execute, deliver the product or service because of the background of the founders or things like that. So that's something else you can add into the competitive advantage slide. So the next one then is traction. So traction is showing all the achievements, all the things that your startup has attained thus far. And so traction is a broad thing. So I have a lot of startups sometimes that they're pre-revenue. They haven't made any money yet. They haven't made any sales. And it's like, so Dave, what do we put in the traction slide? And so the traction slide could mean many things. So if you maybe performed in competitions, you know, maybe got some awards, some recognitions. If you, even if it's non-binding, if you sign some kind of letter of intent or MOU with a potential partner, or you actually have a working relationship with a larger partner, that is traction. You know, maybe you have a unique supply chain where you have unique access to certain things. But another thing that's really important is particularly if you're a lean startup, where if you're practicing lean, you're learning, you're progressing on an accelerated learning curve, you know, with lean. So you're learning more and more valuable insights on your target market. So those insights that you've learned by testing your value hypothesis or your growth hypothesis, those successful tests and the insights you've garnered, those valuable insights on your target market is value. It's intrinsic value, but it is traction. And so that's something that you can list in your traction slide. So even pre-revenue startups can list traction on their slides. There's many different forms of traction. So that's that. And so the next one then, logically, would also be now the client pipeline. So this is a slide that's kind of like, so if you're a B2C company, like a marketplace or something, maybe you don't need this slide, right? Unless maybe you acquire a lot of your customers through affiliate partners or some other type of partners. But you know, a client pipeline here is more for B2B startups, where your startup, that your clients are businesses, and sometimes it takes a long lead time. So maybe from the time when you first engage with a prospective customer and the time that it takes for them to actually become a paying customer might be what we call lead time. It might be 4 months. So 4 months would be between when you first start talking to them to when you get them as a customer. That is called lead time. So a client pipeline actually kind of illustrates the lead times where you are. So let's say you have 20 clients in your pipeline. Okay, for each client, you're gonna kind of like state, okay, this is where we are in the process with each one, right? So client one might be in final negotiations. We expect a decision in a week or two, or you know, they've already paid and they're paying, to all the way to we just made our first initial contact, or we scheduled our first meeting with them, you know. And then all the way in the middle ones, oh, they're in the process of due diligence. Or you know, things like that. So it's just a client pipeline. It's just kind of a list of clients that and showing where you are in each one. And what some people do is do probability. So for each client, at the end of the row, they might say, okay, 40% probability of closing. So it all depends on, you know, two factors on the probability, right? How is it the negotiations doing? How's the engagement going? And then also what stage in the engagement are you in? So obviously, if you're later in the engagement, you're closer to actually closing the deal, the probability is higher. If you, no matter what stage you're in, if the talks are really doing good and you feel really confident that it's going in the right direction, that'll play a factor in it. And what investors do, if you have 20 clients on the list, they can look at their probabilities and say, okay, so the average is like 50%. Maybe I can expect 10 clients out of this, right? So people can look at those different probabilities, and investors might say, well, anything they say over 60%, I'll count them as, you know, good. I'll take them that's what I expect to be actual clients that they close with. So that is a slide that's more for B2B startups, you know, startups that have fewer but larger clients. It takes a little bit longer to close a deal with them, you know. So, you know, for example, I've worked last week with a artificial intelligence startup in the compliance space. You know, their average client is going to be worth about $250,000 for them. You know, obviously they're not, you know, lining up and doing an online marketplace, trying to acquire thousands of customers a month. They, but their lead time could be 6 to 9 months, where so it takes a while. So this is a perfect example of where a startup would have a client pipeline and show where they are in the process for each one. So the next one is challenges and risks. So this is actually a slide that almost is never seen in investor decks, and I think it's a mistake. So challenges and risk is you actually listing the challenges and risks that your startup will face, whether it's competitive, stiff competition, mature marketplace, whether it's a tough regulatory market, could be you could be in a volatile market. So all these different types of challenges and risks that your startup is going to be facing. And the reason why you do that is you want to show competence. You want to show the investor that you understand the risks, but also that if they do invest, we told you what the risks were. So I really realized my first startup was a fintech startup. This is back. This actually preceded the digital media one. This was back in '94, we registered a commodity trading advisor, and as such, we were in the futures market, which is very regulated. And I, as a 24-year-old, we didn't have money to pay for lawyers. And commodity trading advisors are like Dean Witter, Merrill Lynch, big companies. We, two 24-year-olds, we decided to be the smallest CTA in the world. And so we figured out a way to register ourselves as a CTA. Only 7,000 in America registered. And we started the startup. And that was actually my first startup. And so there was a very regulatory market in the futures market. So I was tasked with drafting a disclosure document that we would have to provide every prospective investor. And it was the most terrible document you can possibly read. Having to write that document is like, why would anybody invest with us after reading this document? It was like a horror show. It just listed every catastrophe that could possibly happen, and it was painful to write, and it had to be, they didn't give it was bad because it wasn't like they give you everything verbatim what to write, but everything you write, it had to be to the T. It was crazy. It took several months to write. The format had to be perfect, the lines and everything had to be perfect. And so it was a painful document to write, the most painful writing I've ever done in my life. And after finishing it and after submitting it and getting approved, I just looked at my business partner. It's like, we're never going to get investors. Investors have to read this. We're not going to get our clients if clients have to read this. But then I realized something. You know what? If a client reads this and they invest, they first of all they have a lot of trust in us. But number two is they won't be surprised if there's going to be ups and downs in our trading. They're not going to be, there won't be any surprises, because they've already seen what the worst can be. So that gave me confidence. That actually gave me assurance that after reading that document, somebody invests in us, they truly understand the risks. And if there's going to be ups and downs, which are definitely the case in the volatile futures market, that it would be easier to weather it with them, that there was no surprises. So then I learned the value of having that having the challenge and the risk. But it also shows competence. It also shows that you understand the market. This is not a pie in the sky business proposition that I'm proposing to you. We understand the challenge and risk. Yes, there's a nice risk return. Here's the risk, but here are the returns as well. It's not just the returns. They go hand in hand. So this is an important document because it shows competence in showing that you understand the risk. And sometimes some of those risks And an investor might not just be a source of funding. They might see some of the challenges and risks you're facing, and they might be able to help you with some of them. You know, you might have regulatory risk, and that investor could say, you know what, I know somebody at the, Commodities Futures Trading Commission. I used to work at the Commodity Futures Trading Commission. All these types of things. Oh, I had a startup just like yours, and we had to go through the same process. This is how to really get through this process. So you never know. And you want investors that aren't just for money. Investors become your business partner. And so you want to, when you find investment money, it's not just about the money. They're going to be your partner, and you want them to give you more value than just the money. So you want them to be able to make introductions for you, to give you advice, particularly on maybe some areas that you're not strong with, or your founding team doesn't cover. Maybe you don't have a lawyer, you don't have anybody with legal background on your team, but if you have an investor who's a lawyer, that might be good. So there's all different types of things. So this is another reason why this is a really good slide to have in your deck. The next slide is a future plan slide. So this is a slide that often is not in the investor deck. I think it's a mistake too. But the future plan slide, there's actually a purpose for this. So back in slide 3, we talk about the solution. So in your solution slide, which is about your product, your offerings, you should only list on your solution slide the offerings that your startup currently offers, or the solutions that your startup will offer during given the immediate funding that you're seeking. So let's say if this deck, you're trying to get $200,000 of seed funding. There's a runway, so that money is supposed to last us for 12 months. Okay, so on the solution slide, you should only show to the investor the current products that you're offering that's generating revenue, and then the solutions that, using their money that you're immediately asking for, these are the solutions that will be launched during that runway that we expect to derive revenue from. So you shouldn't add future on your third slide, solution slide. You shouldn't add solutions that you're going to develop 3 years from now, 4 years from now. That's kind of misleading to the investors, because you're not going to be able to get that solution with the existing money that you're asking for. So the purpose of a future plan slide is to differentiate. So the future plan slide is going to give a product pipeline, if you will. Okay, so after the initial funding, we might have to raise more funding. We might have to fund this through internal, from revenue. But these are what we have planned in the future. Okay, we're not going to be able to launch these solutions or offer these solutions with the current funding that we're asking. Okay, but these are what we're going to list in the future. So the future plan slide is important because the solution slide doesn't give a complete picture of what your startup is going to be looking like upon exit. Okay, so this is investors want to invest based on what the exit's going to be, what they perceive the exit's going to be, and that could be 3, 5, 7 years from now. Okay, so and you have plans beyond your immediate, maybe your immediate products that you're trying to develop. So this future plan slide shows your vision, shows the path of your startup all the way through to exit. So you can't show that in the solution slide. So this is why you have a futures plan slide. If you have future plans, sometimes people might be, oh, a project manager tool, that's it. Maybe we'll add more features to it, but that's it. So maybe they don't have future plans. This is it. But for those that have kind of like, over the course of 5 or 7 years, this is what we're going to do. And maybe we're just starting with this product, but then we're going to become a platform, and we're going to have other third-party solution providers offer through our platform and all this other stuff. So this is the chance. The future plan slide is to show your complete vision, your path all the way to exit. So that's an important slide, because investors might like your solution slide and say, okay, that's great, but the target market's still not big enough, or you're not going to be able to scale and get, double-digit monthly growth sustainably unless you become a platform, or we want to invest in somebody who's going to be a platform where you have organic growth, and you're not going to be able to do that with the existing products, even though you could be successful and have good traction. So having that future plan slide is really important. It shows it takes the investor to the journey all the way to the end game. So remember, we're talking about a story, right? So this is the narrative flow. So at the beginning, we talk about what we have now and what we plan to have in the immediate future. And this is the journey. And now here, we're near the end of the deck, and we're kind of wrapping it up. This is the path all the way to the end, all the way to the end point. So this is just one of the late stops in our storytelling. So the next one, the next two slides is strategic partners and teams. So the most important factor for investors to invest is, can these guys execute? It's the management team. The management team is the most important factor. Of investors don't invest in products; they invest in teams. If you're a solo founder, it's almost next to impossible to get funding. The people doesn't matter how good your product is. They want to make sure they're investing in a company that can execute. And so, how do you show the company that you can execute your business plan, that you can execute what you've already up to now have presented? And so these next two slides does that. So the next slide, strategic partner slide, is you're going to list the partners, the strategic partners you plan on engaging with. For each strategic partner, so I see a lot of startups on the investor deck, they say strategic partner slide, and then they just put logos of the company. They might even put down their name, but basically just logos. That means nothing. That's a worthless slide. What you want to do on the strategic partner slide is you want to list each strategic partner, maybe even give the link to that company, and then you have a simple brief description of how it's of mutual benefit. So they're going to want to partner with us because we give them this. We want to partner with them so we have this. So it might be, as a startup, you might be saying, we want to partner with them because we want access to their customer base. The strategic partner might want to partner with you because they want to be able to leverage your technology, or offer your service as a premium feature on their platform. So there's all different ways, but you want to define the nature of that strategic partnership. So is it a co-marketing partnership? Is it a joint development partnership? What's the benefit for each one? So you have to have that minimum for each strategic partner that you list. Strategic partnerships, to me, is very important because between 95 and 97% of all exits of startups is a strategic acquisition. Very few go to IPOs. If you look at the 14 unicorns in Southeast Asia, the ones that valued over $1 billion, most of them aren't even profitable yet. Okay, so it's not about creating a cash cow or making a very profitable business. The reason why startups get acquired, almost exclusively why they get acquired, is because they built strategic value for somebody. So a bigger company sees them with strategic value. You could be losing money on your business, but you become very valuable to a bigger company because they can make money on you. They can make money on buying you and leveraging your technology or you're getting access to your customer base. So this is really important. And so with strategic, if you can, to me as an investor, if you can forge strategic partnerships, to me that means as an investor you can create strategic value for a future acquirer. So this is why strategic partnership slide is so important. Most people just take the strategic partner slide and think it's a wow factor, or just say, hey, we're just trying to impress. No, you want to be a little bit, you want to share that information. Why? What's the mutual benefit? What's the nature of the partnership? What's the mutual benefit? Sometimes the strategic partners could end up being acquirers, or you might be acquired, as a preemptive move, so you won't be partnering with these companies. So there's all these things come into play with this in the strategic partnership slide, and so that's a really important slide to work on and make sure you have clear. And the strategic partnership slide, of course, if you already have some strategic partnerships, okay, put it down. If you have in the future, just list these are the strategic partners we plan on engaging with in the future. And maybe we can say, once we get to this point, then we're going to engage with this startup. So you show kind of a plan, if you will, as well. One of the things I like to advise startups is having MOUs and letters of intent with strategic partners. It could even be non-binding, but it's exhibit A for investors. Investors love it. For example, when I moved to Bangkok, I determined that Bangkok was a great market for my digital media taxi tops. And so that I had in America, that was my second startup. So I started to fish around, see if that was the case. I mean, Bangkok was perfect. It was flat terrain, which is very important because it's mostly the sign is designed for pedestrians. Bangkok, a lot of pedestrian traffic, had wide boulevards, flat. It had an ad market that could support, the ad rates that we would need to get. I mean, everything just seems like a perfect market, but there was no types of digital taxi tops. There was no digital taxi tops in Bangkok. So I wanted to explain. So when you first start a business, the first thing you do is, can I make money on this business? And having spent years on the previous thing, where our model in America was, we're not going to try to place ads on our signs ourselves, because people who advertise on our signs are big companies like IBM and Coca-Cola, and they have their own ad agencies that manage their advertising. And so our competitor in America, they decided to place their own ads. We beat them too, because we didn't do that. We partnered with big ad agencies and said, we're not going to get in front of your ad clients. We'll just get a cut, And so that's the strategy I went in America. So that's or in Bangkok. So I went out there and I met one of the biggest outdoor ad agency in Bangkok. And it's probably it was a great story, but I probably won't get into it too much. But they in the end they decided, oh yeah, we like your signage. And the reason why I had that the initial meeting I had, my objective was, would you put your ad clients in front of this signage? Would you place your ad clients on this signage? And two is how much money you can make on it. Those are the two things, the two questions I wanted answered. And so I went to they had a meeting arranged, and I asked those two questions, and they end up in being affirmative. So then I knew, okay, this can work. And so what I did was, I knew I needed to get investor money. So what I did was I asked the chairwoman, I said, okay, what I did was I drafted a one-page letter of intent. And the letter of intent basically just said, and they would be put on their letterhead. It basically said, yes, we would like to work with so-and-so. We are pleased. We think it's aesthetically, sufficient. We're happy to place our advertising clients on the signage, and we believe we can get $3,000 to $5,000 baht a month per sign. And had the chairwoman sign it. It was a non-binding agreement. They didn't agree to do. There was no commitment. But when I show the investors the projections, this is not assumptions that I'm just making or pulling out of the air. This is who I'm going to be. This is who I'm going to be placing ads through. They're going to be putting their ad clients on it. They've agreed in the letter of intent. They also said we will retain 10% of the ad revenue, the remaining 90% goes to such and such. So, and we believe we can get $3,000 to $5,000 about a month per sign from our clients. This is powerful. It was non-binding. It was a simple one-page letter, but the investors were, no problem convincing them. These weren't numbers that I was, guessing on. This is real numbers. And it was just a simple non-binding letter of intent. So it's very powerful. And since then, the past 10 years, I've been really strongly advising startups to do that. And it's worked in many cases. It's worked. It's been a powerful tool. And so if you have even a non-binding letter of intent, one pager with somebody, that's a strategic partnership. You should put down in there, oh, we have a signed letter of intent with such and such, and so that is powerful. Think about your traction slide. That could be actually on your traction slide as well. This big company, this is what they think of our sign. They're willing to put their ad clients, their major ad clients on our signage. That's powerful, a powerful exhibit to go along with your other prospectus documents. So the next slide is now the team slide, which could be, particularly if you're early stage startup, it could just be the list of your founders, right? You might have 2 or 3 founders, or a management team. So maybe if you're later stage, you have like 6 members, 3 of them are founders and 3 of them are just managers that you hired, but maybe the management team. And so this is the team that's primarily responsible for executing your business model. So on the team slide, a lot of startups, what they do on the team slide is just simply list, okay, this is such and such name, this is their title. Not enough. And someone will go a little bit farther and say, okay, a little brief description under each one, like their background. Has a degree here and worked for a while here. And that's much better. But even if you want to really optimize the value of your team slide, you also want to show that you have really good team chemistry, that you cover all the bases. So for example, let's say if your founding team went to school together, we worked on several projects together. You want to show that, hey, such as these members of this team, they've worked together on several projects. Maybe you all come from the same employer. Maybe 3 of the 6 founders used to work for Ogilvy and Mather. And so you put that down to show that the team has experience working with each other already. So that gives more assurance to the investors that there's good chemistry on the team. So the value of the team is not just the sum of the individual parts. It's can this team has a working relationship together, how well they work together, have they have successful experiences in the past, or just had work experience with them in the past. So that's really important. Another thing you can do in the description of your founding team or managing team members is not just tell them the background, but also the network. So if they have some valuable networking connections, you want to mention that as well. So that's what you want to put in the team slide. So the individual team members, and make sure you cover everything and all the skills. So there's in my the second book, my bootstrapping book, I listed what I call the 4 H's. So the 4 H's is the first H is hacker. So a hacker, first of all, I'll go back. The 4 H's, if you have the 4 H's, to me, you have a complete founding team. And a lot of startups that have been referred to me that want my help in raising money, I won't help them unless they have the 4 H's. Now, they might not have all 4 H's on their founding team, but at least they have maybe a board advisor that fills in a missing gap. But that's really important. You have to have the 4 H's. So what are the 4 H's? The 4 H's is, the first one is hacker. So he's the programmer. They're the ones that do the back end, if you will. So they're the programmer. It's the hacker. The second H is the hipster. So the hipster is a UI UX person. So if you think about technical terms, that's be the front end person. So those first 2 H's are the tech members of the team. So you have a hacker, back end, hipster, front end. The two business H's on your team is the first one is a hustler. So the hustler is your business dev person. It's the person that has the knowledge and experience in the particular target industry, the industry you're targeting. Okay, and then the fourth one is the haggler. So it's somebody like me. It's the finance person. It's not someone that just can raise money and do your finances and accounting, but also tell the development team what's feasible or not, what's the best business model, what's the best revenue model, the pricing, and all that. And so as startup life cycles reduce over the course of the last 20 years, it becomes increasingly more important that you have all those 4 H's in the earliest in your life cycle, you know. So before you're like, well, we're not going to hire a hustler until we do a commercial launch. We're not going to hire a haggler until we need to raise money, you know. No, they actually play a very important role in the development of the product, in the early development of the product. You know, development team might have a hard time developing the right product if they don't really understand the target market, like the hustler knows. They might do the wrong architecture based on the business model that the haggler would propose. So you want to have a complete team as early as possible. And if you don't have a complete founding team, which is often the case, until you get a co-founder that fills that, you can get a board advisor. So another slide that possible slide I don't have on here is right after the team slide, you can have a board advisor slide. So it's not a board of directors slide. These aren't directors on your board. These are board advisors. So these are people that fill in the gap. So for example, for me, I've been a board advisor for several startups that don't have a finance person. You know, they have a marketer, they have, you know, they got the tech people, everything all set up, but they have a hard time finances. So I might come in, sign a board advisor agreement, get a few points of equity, and then I help them with the fundraising, with the pricing model, all that, and help them along until they can get to a state where they can hire an in-house CFO or somebody, a finance guy. So this is something where if your team slide, you don't have a complete team, you could go find board advisors and have a board advisor slide and say, oh, here's our board advisors. And the board advisor slide is very similar as a team. You want to give a description of who they are. Maybe they work for a big company, reputable company. So now you want to talk about their background and skills, but also their networking. You know, what's their network? What's their professional network look like? And so this is really important. So this could be another slide after the team slide. So now we're coming to the end of the deck. So the next slide is a pro forma financial summary. So to do this, you have already had to complete a set of pro forma financial statements, probably a balance sheet, income statement, and cash flow statement. The most important one is the income statement. And this is what the pro forma financial summary will be based on. So after you have your Excel sheet and you show like your financial projections for the next 3 to 5 years, your revenue lines, your cost of goods service lines, your fixed costs, your operating cost lines, your net margin, your gross margin, net income, all this, what you're going to do is on the pro forma financial summary slide, you're just going to pick 4 or 5 things to highlight from your actual pro forma financial projections, and you're going to put it on here. So for example, here, you might list for like a little chart where you do it by quarter for, let's say, the first 3 years. And you show, okay, here's the, you know, for each quarter, here is the number of new subscribers, you know, the total, the revenue, you know, here's the incremental variable cost, the cost of goods sold, if you will, here's the gross margins, and then maybe net profit. So you're just doing the highlights. You're not getting too specific. So the investors, if they're further interested after the deck, then they can sign an NDA, and then they can see these more detailed numbers. But this is just a summary of those numbers that you've created. So whatever you put on here, you have to be prepared to be able to show the investor, yeah, this is what it's based on. So that's the pro forma financial summary side. So it's going to kind of show them the returns, right? So at the end of year 3, we expect to have this much revenue, you know. we're asking for $200,000 for a 12-month runway. The investors are going to be able to look at that fourth quarter that you list and say, okay, so this is how much revenue are they break even yet, or have they become profitable? So they'll be able to see that and kind of judge it. And once they do get hold of your pro forma financial Excel spreadsheet, they're going to tear it up anyway. They're going to put in their own assumptions. So I recommend startups, when they do a pro forma financial summary on an Excel sheet, instead of having the revenue lines at the top, what I do is above the revenue lines, I have assumption lines, and so it will allow investors to put in their own numbers. So you might say, first quarter, we're going to get 500 new subscribers. The investor might say, nah, my assumption is I think they're only going to get 300. So you're going to allow them to be able to put 300 on the assumption line. And when they put 300 in, it changes all the other lines below. The revenue lines change, the variable cost lines change, so all that changes when they change that number. So 99% of the time, startups are not going to buy your numbers, your assumptions. So you don't need to make least case, expected case, and worst case and best case scenario. You don't have to do all that. You just simply put assumption lines at top, let the investors put in their own assumptions. And the most important thing is to have them buy your business model, and let them put in their own numbers for as assumptions go. So that's to me the best way to do it. So after this, after you've shown kind of like here's the returns basically, now you have the investment opportunity slide, or what a lot of people just call the ask slide. So the ask slide is basically saying to the investor, this is how much we're looking for. We want $200,000 in this round. This is what we're going to give you. For $200,000, you're going to get 20% of our company, or equity in the company. Okay. And then you're going to give runway. With $200,000, that'll be enough money, assuming we don't have any revenue. This will be enough money to cover 9 months. So we'll have that. This gives us a 9-month runway, or this gives us a 12-month runway, maybe 6. And so this is what you're going to do. And then you could also put on this ask slide. This is kind of like what the money. This is objective of getting the money. So we want to get to break even, or we want to get to 1,000 subscribers. This you can have a kind of like a KPI for this particular, or KPIs for this funding round. You can put that in the ask slide too. Usually most cases it's just, we want $200,000. We'll give you 20% equity. That's the offer. That's the ask. Sometimes they put runway in, but I would recommend at least doing the runway, and then what you tend to accomplish by the round, you can. That's optional, but I think it's beneficial to put it in, but I don't think it's really you can do without. But I think it's a good idea if you know that, and if it's compelling. So now that you've told them how much money you want, now you have to have a use of funds slide. So now you say, okay, I need $200,000. This slide, use of funds slide, you're actually giving them an itemized list of how you're going to spend that $200,000. So if you give me $200,000, I am going to put 60,000 of it toward product development. I'm going to put 80,000 toward sales and marketing. I'm going to put 40,000 on operating expenses, and another 20 or whatever on G&A. Okay, so the use of funds slide is very important because it tells the investor kind of like what stage of development your startup is in, and also it's be a big factor in them determining the price or the valuation of your startup. So the higher the percentage of your use of funds goes to, let's say, sales and marketing, which is direct return on investment, more direct return on investment, because you get more. That's helping you. That spend is getting you more paying clients. The higher percentage of sales and marketing, the higher the price, the valuation they'll probably give you. If you're mostly product development, that probably means you're at an earlier stage. It's more risky for the investor. so the lower valuation that they're likely to give you. And so operation expenses kind of could be show whether you're risky or not, and that operational expenses is equivalent to, let's say, a burn rate. So these are usually mostly your fixed costs on your operating expenses. So no matter how well you perform, this is the burn rate. This is what investors expect, that at the minimum you'll have to pay to stay afloat, to stay operating. So that plays a factor. And if your G&A is really bloated, the investors might start looking at your salaries that you're paying yourself, and some other expenses that they might think is wasteful. So these general, so you're going to list them in general categories: product developments, operations, sales and marketing, G&A, those type of things. So if there's a capital expense in there, you're going to mention a capital expense. So all that goes into that. So that's the use of funds. Very important slide. And then then you end your deck with the exit strategy. So the exit strategy is basically saying this, and it's really for startups, is almost by default. So a type of exit is usually merger and acquisition or IPO. Well, I mentioned to you before, 95 to 97% of exits for startups is them being acquired by a bigger entity. Very few reach it to IPO. In fact, the startups that reach IPO are kind of on the failure side. Not failures. I mean, they'll make good money, but what that means is you've been around for a while. You've never created strategic value for your startup. You become a cash cow. You become financially successful startup. That's why you grew big enough to be underwritten for an IPO. But you haven't created strategic value. So a lot of times, so you probably, for IPO, it takes longer for a startup to attain, and you're probably not going to get the return on investment. Let's say if you got acquired, because people that acquire you for strategic reasons are going to pay a much higher premium than somebody's going to acquire you because of your financial statements. So which is what happens when you become an IPO. People look at your financial statements, you're deemed big enough or lucrative enough to be underwritten, and then your shares are publicly offered. So, but with a strategic exit, and you probably pretty much have to be fairly profitable to get to IPO, whereas a strategic exit, for a comparable company, maybe for a company doing the same thing, one becomes a cash cow, maybe takes them 10 or 12 years, then they go IPO and get 3 times return on investment. And then you got the same company, but was able to attract attention from strategic acquirers. That company might exit in 3 or 4 years and command a much higher return on investment for the early stage investors and founders, because strategic value is worth a lot more than financial value. And so as a startup, you're always thinking about, who am I creating strategic value for? Why would someone buy me? Why would somebody acquire me? It might not be finances. You might be not making profits, but maybe somebody wants to buy you because you have 100,000 SME clients on your platform, and that bigger company wants access to it. Maybe you're not making money, but that bigger company can, if they just have access to your 100,000 SME clients. So this is something that you have to think about. And so the exit strategy, actually, recently, the last 5 or 6 years, the conventional wisdom was they don't put an exit strategy slide. And Peter Thiel, who's one of the founders of LinkedIn, says this. And I agree with him on 99% of the time, but I vehemently disagree with him on this, because exit strategy, if you don't have an exit strategy slide, as an investor, I don't even know whether you even wanted to exit. Maybe this is a lifestyle startup for you, and you're not even looking to sell your company in the future. No matter how successful your company is, if you don't want to exit, there's no return on investment for me. I didn't invest in you to get dividends. So if I want dividends, I'll invest in the stock market. It's a lot less riskier. So Peter Thiel's in the Silicon Valley world, where every startup, it's assumed every startup there is looking for an exit. That's why they're in Silicon Valley. But in most places of the world, that's not exactly the case. So I see many investors shake their heads and going, well, you know, they don't want to grow. They seem satisfied. They're not very ambitious. What was their exit strategy? Oh, they didn't have an exit strategy. Okay, why did you invest in them then? You know, as an investor, if you don't have an exit strategy, I'm not going to invest in you. But the thing is, Peter Thiel is right in one regard. He's absolutely right. He says the reason why you don't have an exit strategy is because, you know, whatever exit strategy you conceive of, most likely that's, even if you exit, that's not how you're going to exit. Now he's 100% right on that, but doesn't mean you don't have an exit strategy. You know, you have to have an exit strategy to work towards too, you know? And so, you know, you don't go into a baseball game or a sports game that says, we're not going to have a game plan. And say, why? Because it never works that way. We're not going to get into a fight and not have a plan. And, you know, why? Because it doesn't work out precisely the way you want it. You still have to have a plan in place. There's still value on that. So, you know, it's really important to have an exit strategy. One, just to let the investors know that, yeah, we want to exit someday. You know, a lot of, and it's okay. I mean, a lot of, you shouldn't be raising equity funds if you want to keep your baby for the rest of your life. If you say, I want to start this company, maybe I'm making a lot of social impact. It's not about money, you know, and that's fine. That's perfectly fine. But you have to be honest with, you probably shouldn't be getting equity investors. You should be getting maybe investors that have the same interests. Well, we're not looking for a max optimal return on investment, but we support this mission, you know. And so you have to be, you know, so picking, depends on what your ambitions are. You have to pick the right investors for it, you know, because the worst thing is that if you get equity investor, they want to exit in 5 years and optimize their return on investment, and you're just like, that's not what your primary goal is. You're going to have conflict, and it's going to be a problem. And so the fault is both ways. The fault is on the investor for not asking to begin with what your exit strategy is, and number two is you're accepting equity funds, knowing that there's a conflict, that there's a misalignment of interest. So that's really important. So that is the end. That's the last slide in your investor deck. And so what we're going to do now is I'm going to get out of this, and I'm going to put up a sample investor deck. So just give me just a second here.
Dave.
Yes.
Just want to give you a quick reminder.
Yeah, I got about 15.
Because in terms of the time.
Yeah, I see. That's okay. This is why we can, just the investor deck left. So this is good.
Awesome.
So, perfect.
Awesome.
Yeah, thank you. So let me go ahead and get back to this. Okay, share screen. Okay, here we go. So I just want to go through a sample investor deck that I thought was really good. One of my graduate students last semester, she made an investor deck based on a local startup. So my graduate class that I teach, one of the assignments is I asked every student, I give them a list, I give this class a list of 50 startups, local startups with the links. And I tell them, okay, each one of you is going to adopt one of these startups, and you're going to create a lean canvas for each one and present, and you're going to create an investor deck for each one and present. And so that's the assignment for my graduate students. And so one of my students last semester, she created an investor deck for a local project management startup called Blue. So she did such a great job with it that I asked her permission if I can use the investor deck that she presented. And Manny, the founder of Blue, who I know very well, that I advise as well, so I know his company very well. I asked for his permission. He's no problem. So I can't share this. I can't post this anywhere, but I can. I have permission to show it. So I won't be able to share this with you or give this to you, but I can show you what a really nice, what I feel is a real nice investor deck looks like. And that presentation that I just presented to you, that's the presentation I presented it to my graduate class that she followed, and she created this investor deck based on those instructions that I just gave. So it just here's the, and she made some little bit of deviations from it, but that was perfect. I mean, because it was perfect for this particular startup. I mean, she did a really good job. So first she just started out with like content. So I think she did this just to make sure that I understood that she was following my my lead as far as the progression of slides and stuff. So usually on your pitch deck you probably don't need a content slide at the beginning, but you don't. But she just put it in there, so it was good. So the business summary. So she just wrote a really great business summary that for 3 or 4 sentences, she packed conveyed a lot in just 3 or 4 sentences, she was incredibly concise, but shared a lot of information. So Blue, a software as a service product, providing an all-in-one solution to project management. We put emphasis on simplicity as the core of our business model, from user-friendly interface to simple minimal features and a single pricing point. So this is Blue in a nutshell. You couldn't explain it to it more concisely better than this. So Blue was created by a design agency. So there's a design agency called Mad Design that developed this project management tool first internally for their own use, and then they decided to commercialize. And so I've worked with a lot of project management tools in the past, and they all were feature-based, feature-focused. What are the features we add and things like that. Blue is successful because they focus on design, on user interface, on user friendliness. So this is a huge competitive advantage for them, that it was designed by designers, not by people looking at, okay, what are the features that people have, because most project management tools are overloaded. 90% of the features that are in project management tools are needed. So in a nutshell, she basically gave the 2 important competitive advantage. It has superior user interface, and it has a simple pricing point. So a lot of project management tools are like, hey, we charge $7 a user, and doesn't matter how many features you use or whatever like that, or if these features will do premium pricing. Blue says, look, it's $50 a month flat. It's $50 a month. You have 2 choices: $50 a month subscription or $500 a year annual, and that's it. And with that, you get everything, and they're constantly adding new features, and every time they add a new feature, that is a marketing opportunity for them. But what's great about them, they have no marketing spend. Their marketing spend is 0. They use marketing partners and they use affiliate partners to drive traffic to the site, and marketing partners to actively seek customers, paying subscribers for them. Now they give pay out steep commissions to these marketing partners and affiliate partners. However, that's a variable cost. They don't pay until they have the paying subscribers that pay themselves. So it's a great business model. They launched like maybe 9 months ago, and they have paid customers in 114 countries already. And they're based here in Cambodia. So it's pretty successful platform. And so this is she just summed it up in the business summary, just like that. I mean, that is a perfect elevator pitch. So if you're stuck in an elevator with an investor, that's how you do it. So the next one is the problem slide. So she just basically simply states the problem proposition. Businesses are using many different tools to communicate, store files, and manage projects. So this is a project management tool that kind of puts all that together. And so she just lists some problems that teams have, and so these problems that she lists, okay, this is the solution. This is how Blue addresses those problems that she stated, so she uses some visual, which is nice. And you want to, in your slides, you always want to limit your text, right? And you try to convey as much as you can with visuals, whether it's a chart or screenshot or something like that. So that's what you want to do. And then next, so this is part of the solution slide. So this is a second solution slide. So she's just listing features. And a lot of these features, we will go back to the problem slide. They match. How does it work? So this is the customer journey slide that we talked about. So she walks you through what the customer experience is from the beginning right to end, you know, right to when they become a paying customer. So and you can see she illustrates it so quite effectively in 5 different steps. Then she talks about market validation. Now, what's interesting is instead of giving a target market and the 3 like serviceable, addressable market, things like that, this market is so huge. Project Management Tool is a global market. In fact, they have paying customers in 114 countries. How do you measure that? You know, any business with a team is a potential addressable market, part of the addressable market. So what she did was she listed the traction of some of the bigger global project management tools. So she said, you know what, market validation. So she didn't call it market opportunity. She called it market validation and said, look, Basecamp has 120,000 customers. Asana has 50,000. This is obviously the demand for project management tools are there. So she's kind of showing it's a mature market. So there's the validation there already. And then she talked about the target market. And she gives, it's really important, you list the different levels, but you also have a description of each level. What do you mean by that? So this immediate market that she's targeting, these are micro and small size startups or agencies, but there's no geography because it's truly a global platform for anybody. So it's not a geographic designation or anything, she just lists, it gives a description on each level. Okay. Next one. And so the business model, very simple business model, right? It's $50 a month or $500 annual plan. So that's what you get. They also have enterprise product, which is more, these are for large companies that may need some customized work. And so this isn't the scalable part of the business. This is kind of like, okay, if we have a big client, we'll do this work for them actually do this development, but we'll charge them a lot of money. But for the most part, their business is this. It's scalable business. If a subscriber wants to subscribe, they simply go to the website and hit the subscribe button. Then there's payment terms and that's it. So that's where you ultimately want to be as a startup, where it's easy sign up, where you automate things as much as possible. The more human beings are involved, the less scalable the business and the less attractive you'll be to investors. And then the value proposition. She does a great job. She just lists, all the different values that the users will use, So the people that are driving value are teams within companies, so it's done really effectively. So it just lists the value proposition here, which is basically aligned with the features that they have in their platform. And then the marketing plan. So really they get almost all their clients through either marketing partners who are partners that actively solicit paid subscribers on their behalf. So they pay out big. They pay like 70%, 5% out. So if they pay $500, about 400 of that is being retained by the marketing partner. They only get maybe 100, but it's no cost to them. They have zero marketing spend. And affiliate programs, they pay 50% commission. So affiliate programs don't seek paying subscribers. They simply direct traffic to the Blue site. In any conversions, Blue pays them 50% commission. So again, Blue doesn't pay unless they get paid subscribers. So basically all the marketing expenses for Blue is completely variable, which is a very sustainable, scalable business model. Maybe they don't have the margins, but they're not looking for that. They're looking for value. So a competitor, so this is an example of a matrix, right? So, and they're placing themselves as affordable and minimal features. And so these guys have a lot of features, but they're very expensive, so you're paying for those features. But the problem is for these guys, most companies probably only use 10% of the features that they offer, and so these guys are more on the expensive end, So they take themselves out of much of the market because they're expensive. These guys take themselves out of the market. They're affordable, but they have too many features. It's feature overload. And then you have somebody like Microsoft Teams, which I guess is relegated to the bottom, right? They have minimum features and expensive. And then you have these guys. So these guys are more formidable competitors for Blue. So they come in, but what they have an advantage of is that they have superior design, they have superior user interface, and they don't. I think these guys pay per user too, so I don't think Blue. I think Blue, their competitive advantages against those guys. And then sorry, go by. So after the competitive matrix, they list their competitive advantages. So their advantages is, being a Cambodian startup, all of them need customer support staff, right? All the project management tools do. But, a customer support person in Cambodia might cost you $300-400 a month, where in San Francisco, that same person doing the same thing is going to cost you $4,000 or $5,000 a month at least. So they have a advantage as far as where they are, and understanding of customers and market. So they are designers themselves, and they're kind of targeting like design agencies and people more creative agencies. And they have strategic partnerships, i.e. they have no marketing spend. All their marketing is variable cost because they have marketing and affiliate partners. Totally different business model than their competitors. And so traction, they have some actual numbers, early numbers, but they're very, very impressive. So usually traction, you want to show a growth rate, you want to show total number of paying customers, there's a conversion rate because it's a 14-day free trial, all this stuff. So that's an example of a traction thing. Here's a customer pipeline. So the customer pipeline for them, they're not a B2B business, but they have, their pipeline is customers that are using the 14-day free trial. So as an investor, if you know that the conversion rate is 40%, and let's say they have 50 customers currently on a free trial, the 14-day free trial, then you know that 25% of 50, you can expect at least 12 or 13 new paying clients from it. So this is kind of like how she does cleverly the customer pipeline. Is she uses the people on the free, and then she uses some engagement metrics. So we do have over 9,000 newsletter subscribers. So these are potential free trial users. So, all the traffic that there's daily views that are non-subscribers, these are potential people that become free trial users. So she uses engagement metrics and free trial numbers, free trial users as a customer pipeline, which I thought was cleverly done. Challenges and risks. So she kind of lists some of the challenges. This is kind of like standard, but she probably didn't have to put that in, but that's good. They competing on volume rather than, so their margins are a lot less than their competitors, but then again, there's a lot less riskier because they acquire through variable marketing expense through their partners. So their margins are far less than their competitors, but they can experience rapid growth. But there's just some of the trade-offs or some of the risks that she puts in there. And then future plans. So this is kind of like, this is really a feature pipeline. So they're not developing any new products. They're just adding more and more features to what they have. So that's it. And then strategic partners. So they just mentioned some of the marketing partners they have, and how it helps them get the customers. And then the dream team. So she just puts in and she kind of explains, so all the people, their titles, their backgrounds and stuff. And then there's the pro forma financial summary. So remember, I told you just pick 4 or 5 highlights, right? And you can do it by quarter or by year, and so just number of customers, revenue, expense, headcount, operating margins. Usually you have gross margin and net margin. That would have been probably better numbers to have. So but that's how that's done. And then investment opportunity. This is the ask slide. This is what it looks like. We're asking for 350K. We're willing to part with 17% equity in the company. This 350K will give us 18 months runway. And then this is our KPIs. This is what our objectives are with this money. What we want to do with it. Okay, and then the use of funds. So if you give us 350K, we're going to put half of it in product development, 20% new hires, then customer acquisition. So they might end up with the money actually having their own marketing budget. And then exit strategy. So she's listing in the exit strategy, she's listing who would be a potential acquirers, and why. So that's an exit strategy. So that is it. And of course, at the end of the slide, you always give contact information so investors can actually contact you. So that is it. Is any Q&A? Any questions?
Yes, thank you so much, Dave. So let's look forward to our idea boards, because I already sent the link for all the participants to go to if anyone have some question. Knowing that, let me share it with you here. Okay, wait. All right. So far we have two questions coming up from Mason. So the first one, from investor point of view, which slides or parts should we put more emphasis on?
Okay, I'm going to flip that, and I'm going to say from an entrepreneur's point of view, you're going to put more emphasis on what is the strengths of your startup. Okay, you're going to highlight what you think is your best parts of your startup. Really highlight that. For the investors, again, management team is the most important reason why somebody invests. Is the management team. They can buy your product. They're not investing in your product. They're investing in your management team. So in a management team slide, people don't put enough effort into it. Really sell your management team. And if you don't have a complete management team, get board advisors. You don't have to pay them. You don't have to give them anything. Some of them might be, they want to support you, and every now and then you can give a call and they're happy to give you advice. But make sure you have all your bases covered on that, because execution is really important. Another thing is that risk, mitigating risks. So you want to, and I brought the last class, the last deck. I provided like risk mitigating factors, RMFs, and I have a more comprehensive list in my first book that I have almost a whole chapter on, but it's showing things like, we have multiple revenue sources, we have multiple customer segments. Anything that diversifies risk, that spreads risk out, that makes things less riskier. If you're a startup and says, oh, my revenue is primarily ad revenue. Well, ad revenue is very volatile, so it's very risky. We only have one customer segment. Well, if the market of that customer segment goes down, you're in trouble, if you're in just one market, one customer segment. We only charge transaction fees, what happens if the volume goes down? Do you have anything else, So it's, you want to be able to show that you're managing, that you have, that things aren't so risky, so you want to show if you have backside protection, and things like that, and earn the trust of others, like strategic partners. So that's really important. For me as an investor, I'm looking at the strategic partner slide. I'm looking at the team slide. To me, that's really, really important. The numbers, I'm going to come up with my own numbers to tell you the truth. You should be reasonable on the numbers, but tell you the truth, a lot of people think that's the most important thing. I think that's one of the least important, because investors are going to they're going to put in their own numbers, but you want to make sure that in tandem, the problem solution side is a good match. Okay. You want to make sure the problem solution side is a really good match. And you want to be able to do a really good job on the competition to show that you have the value proposition and your competitive advantages are really important. because that's your positioning in the market. So those are really some good ones. So to put on there.
All right. Thank you, Dave. All right. The second, thanks for sharing the example about what is an epitome of an objective slide look like. Okay. I guess you already shared it before, right? On the objective slides.
On the objective slide, what an epitome of an objective slide? Oh, channel example. What's an epitome of an objective slide look like? So she had a few slides that had objectives. I remember you mentioned about.
Yeah, I guess
Oh.
mhm.
Oh, okay. So, well, objectives. Like what part of it? There's a few slides.
Mhm.
Oh, okay. So objectives. So that was me saying that I wanted to point out what the objective of each slide was. So that wasn't part of the assignment for her to regurgitate what I told in class. So that the objectives was just me saying, for each slide, I want to make sure that you understand the objective, what you're trying to achieve for each slide. But no, she didn't put the objective in. But she succeeded for the most part in each slide in that objective that she was trying to convey to the investors. So that's what that was.
Yeah, I guess Maysan was also dropping off like earlier as well because she had another thing coming up. So yeah, I mean, later on, all the videos, most of the videos of our events, it will be up on our YouTube channel, so everyone can check it out there. Maybe anyone have some other question? Maybe Dylan or Ons?
And you could be specific. You have a specific question on your startup or how you might want to do it as well.
Yeah. So
I mean, sorry, for our startup is we're still struggling in defining our business model actually. So we developed a product to detect COVID-19 cases through voice. So the idea is to use voice, sound, I mean cough and breathe, and to do disease diagnosis. So the vision is literally, we hope in 10 years you wake up in the morning and say, good morning Alexa or Google, and you can have, the algorithm will detect that change in the voice related to a disease, which can be thyroid cancer or lung cancer, because these two diseases, the first symptoms are the change of voice, but individuals cannot capture that, so while the machine can do that. Anyway, so for now we are working with COVID-19. We worked with COVID-19. Actually, we've got certified in Europe. We haven't been out yet there, but we are working in on the second product, which should be on COPD, the people who have respiratory challenges. So the idea with COVID-19, we didn't want to put it there in the market for, so go B2C, because we still need data, the specificity and sensitivity. You know, the characteristic of the algorithm are still rather low. They're not at 90%. So we need more data to improve the algorithm. That's
okay, so this sounds fascinating. So what you want to do is you actually have a chance to do B2B and B2C, but you might want to do one before the other. So you have, this is hardware, right? So
no,
what is
no,
the?
it's not. It's not. It's an app on the phone.
Oh, it's an app on the phone. So the phone, somebody be able to breathe on the phone and be able to.
Yeah. You use your phone, your
okay.
iPad or your computer. You don't need, actually, that is the beauty of it. That is
okay.
it
well,
can
this
be
is
available
definitely
to any
B2C
person.
Because usually what happens is like so let's say if this was a piece of hardware, like a piece of machine, usually you would say, okay, do B2B first, sell to hospitals, sell to government agencies, sell to NGOs, If the product needs like some expertise to actually man it and use it, you have to go to B2B route as well. And so then eventually, once you have the algorithms figured out and things like that, and you can make the piece of hardware device more affordable, then you can go the B2C route. However, in your case, you're going right off the bat. You're saying there's no device. We're not selling device. It's an app, and it's able to measure your breath, what's coming out of your breath, and determining these diseases. So this is definitely sounds like this is a B2C right off the bat. And so now the second question is, what kind of regulatory approvals would you need on this? So let's say if you're able to develop the app and you can actually do this, it's a medical, it's still in the medical area. So there's going to be tests, I'm sure, and it's probably in different countries unless you can get something, let's say a WHO or something. And, so there's a lot of upfront costs from the regulatory sense, I suspect. But once you get that approval, especially if it's if you do it by country, if you have to get approvals by country, then it becomes kind of, you have to pick the right countries that, you have to say, okay, this has the least path to resistance, but a big enough market where, we can get, we can optimize the number of customers compared to the cost of regulations and being able to list it. And so, but if you're able to go right up to, let's say, global level, and all you needed was authorization or certification from, let's say, the WHO or some global body, then that's different, But I'm assuming that you probably have to go at a country level first. So one of your major tasks is, one is you're going to come up with the cost of actually developing the app, right? And actually being able to have that product, and then the demo. So you're going to have to demo it. You have to have at least a demo, and you probably have to use a demo to get regulatory approval first before you can figure out, okay, now we're going to figure out the distribution. I wouldn't worry about the distribution now. I would worry about developing the product, having a demo that is good enough to show a regulator, hey, this works, So you probably have a short list. If maybe you do not have a list, maybe you just have one, it's just to detect COVID, right? Or maybe there's other things you can detect with that. So of course, the more diseases or viruses that you can detect, of course, the better. For example, if you can detect 4 different things, COVID, and let's say 3 other viruses, then it becomes, the search of coming, what country should we launch this first, So that the answer is, well, you're going to pick a country that has have a bigger incidence rate of these particular diseases or viruses that you can detect, right? Then the second thing is, of those, what has the biggest potential marketplace, given that they would have to purchase the purchase price, the demographics that would buy this, right? The market, the size of the market for that particular country, and then third, the regulatory path. Which ones, so you look at those 3 things: regulatory path, market size, and prevalent and incidence rate of those particular viruses you can detect. And you take those 3, and that's going to help you determine what's the best country or countries to initially target. And that's where you want to, once you develop the demo, that's where you want to go to those countries to say, okay, let's get regulatory approval. You might just want to just target one country, depends on the regulatory cost, show the proof, show that this works in this one country, then it'll may be easier for you to go to other countries and get things passed, and you've proved that all out. So you don't want to spend a lot of money on marketing at the beginning. You want to stay lean. You just want to get a regulatory approval in a country that offers the least path of resistance, but at least has a marketplace that's big enough that you have some runway so that you can get break even. That gives you a cushion so you can go after the other markets.
Thank you. We've done actually all that. We've been approved, and we have the approval from the health ministry. And we've chosen the first market as Italy because for different reasons, because of exposure, because we want different grants, and anyway, we were really well exposed. The idea now is to go to we haven't finalized the agreement with the airport, but we are going towards B2B, B2B2C at the end of the day, because people are using it, or employees are using it to go back to work as normal. This for COVID-19 is valid. For the next product should be more B2C. So I'm asking from an investor point of view now, because we still don't have any real income coming in, but we have all these preparatory paths, we've done it. So could you, in the investment, what is next? Do you think that we can present the case of B2C for next? Because with the money we are looking for 1.5 million now, and this money, the runway is just to have market penetration and being in order.
So in a regulatory environment, no matter how great your product is, unless you have the regulatory approval, you're not going to get a dime. However, once you get regulatory approval, then the floodgates open. So I won't even worry about marketing, because that is the money that investors will be throwing at you once you prove everything out. There's two validations you have to do. So one is product validation, which you already done for the COVID, it sounds like. You've shown that we have an app developed and it works. And then you're probably going to have a percentage rate where it works. It's 90% effective, just like the viruses out there, right? I took this, it's 91% effective. So you're going to say, okay, this is the effectiveness of this. And so then, of course, if you get that approval, you have that license or certification, you have all the results, right? The effectiveness results. And so that's the COVID thing. So that's product validation. Now, what you need to do second now is business validation. So instead of going to the B2C route and going the different, maybe more than spending beyond COVID, you have that COVID and you have that product validation for this particular country. Go out there and show to the investors that you can make money just on this. So this is this one country and this one product, COVID. Go out there and show and prove out value proposition, now the business value proposition, that you can actually scale this up so you're making money. So you're following kind of like the lean process, you know, Steve Blank's business model, you know, crossing that chasm now. So you went there, you showed effectiveness of the product, that's product valuation. You show the value you're delivering to a particular hospital and employees are using it, kind of showing that this is this could be a B2B. But then again, you're just using the B2B, they're just testing it. They may be paying you, but now how much would it cost for you to get more hospitals on this, you know? And then, so what I would do is my step-by-step is this. I'm in Italy now. I got regulatory approval in Italy. It's just COVID and it's just a B2B right now. I would first, my second step now would be to try to, whether you need to raise money or not, but this will be based on it, is try to prove the business proposition for the B2B for just COVID in Italy, okay? And then once you prove that out, then go to the B2C route just for COVID and in Italy, okay? And once you got that, you showed the investors, later stage investors, our product works, we can make money on the B2B side or the B2C side. So now I've just shown the investors, if I go to a new country, so every country, the preferred model might be B2B or B2C, it might not be both, but you've already demonstrated in one market that you can go make money on the B2B route or the B2C route. And it's just the one thing, but they can easily extrapolate. If this works with just COVID, if she adds COVID and another virus to it, of course it's going to be more valuable, and the marketing channels are going to be the same. And she's already proven the value and now the growth proposition. So prove out the growth proposition. So just step by step. You're in Italy right now. It's a big market. I'm sure everybody's excited about your product because they really took a big hit. I mean, they really suffered, and it's a big market. And and you showed B2B, which actually I think is the harder nut to crack. So if you can show that, okay, this works in one hospital now, okay, you can go to investors now if you need money. Just get enough money to do the B2B in Italy, okay? Then once that's proven out, you'll be able to go to the well again and go to investor, not even the same investors. We need money now to do the B2C in Italy, okay? You nail that, and then you go to bigger investors, say, look, now we need money. This is our next target market. We need money now for the regulatory approval, and then at that point too, the funding for regulatory approval for this new country, and the B2B or B2C, whichever one you think is the best one to start it off initially in that country. And so there's a step-by-step process. You don't have to get all the money in all one swoop. Just go step by step at a time. And for each funding round, you'll be able to justify a higher valuation. You're going to get a better price. So you're going to minimize the amount of dilution that you as founders have in the company. So, but if you can get grants, that's another reason. That's the fourth reason I missed, but you point out, you're going to pick a country. If you can get non-dilutable funding, take it. If they're going to give you grants, take that all day. Don't raise equity and dilute yourself,
That's what we've been doing so far. I mean, yeah, bootstrapping and grants, surviving with that actually. So yeah.
That's fantastic. I think you're on the right path, but do it, the fundraising, do it iteratively. Like I said, don't try to get everything all one fell swoop. Have those objectives. You're already in a country. You already have this, just baby steps right through. Get successive rounds of funding, and you'll be fine. So, it sounds like a great product. Quite. You would have a greater market. You have a great market here in Southeast Asia. I'll tell you that, right, Kasmi?
Yeah, that's true. That's true. That's amazing, Ons. Well, good luck with the product. It sounds super exciting, and hopefully that everything goes through with the project and everything. All right. Well, thank you so much. Thank you so much, Dave. Thank you so much, everyone who stick around still. I'm super excited, and thank you so much, Dave, for all the knowledge that you share with us today. I'm pretty sure that everyone can already take some notes, and then
I hope so. I hope this helps. I like to see everybody succeed,
Yes.
And it sounds like everybody's working on something exciting. And
Yes.
Hans, I wish you all the best of luck. If
Thank
you
you
have
very much.
further questions, just shoot it out to me.
Yes. So
Keep me informed. I'm actually really want to know what's going on. This, this sounds like pretty good.
That's true, Ons. Like, keep us posted. If you have some other question, or if you still want to connect with Dave, I already share it on the email, the following up email after this. I guess it's already shared to you guys, so feel free to check it out. I also left Dave's email on there on the chat box, so feel free to just save it and then connect with him later on. Before we close, just want to let you know, so in the next coming 2 weeks, we're going to have another session together with Dave as well. So Ons or Dylan, if you would like to coming in, feel free to do so. Dave, maybe you want to share a little bit about how it's going to be.
Yeah. So the next session will be a mock pitch. So I'm not going to be presenting anything in this. So there's going to, if you're a startup, if you have an investor deck, and hopefully 2 weeks, it gives you time to work on it. It's not meant to be perfect, right? You're going to actually present. You're going to have 10 minutes to pitch your deck to me. You're going to pitch it just like I was an investor, and then I'll be able to give you feedback, And so it's better for me to give you, run you through the gauntlet than to say an investor, So I can give you the feedback from an investor's point of view, that you'll be able to take as constructive criticism or praise or whatever it is, And so the 2 weeks from now, when I do this section, I'm not presenting anything. I'm just hearing entrepreneurs like yourself just pitch to me. The peers will be there too, so they're welcome to give feedback. Maybe some of them are more experienced. They've pitched before and they can share their experience, and so we're going to make this so that we're all interactive, helping each other out on this. Everybody's sharing what they have and what they know. But it's
Yeah.
basically, that's a simple format. You send your deck to Cassidy, he sets everything up, he'll be the host. So I'm just there concentrating and asking the questions or giving feedback. So I'm not going to say anything during your presentation. You're just going to present right through. And if I have any questions or have any feedback, I'm going to be the student here. I'm writing it down and asking the question. So the role will be reversed, basically. But that'll be fun.
Yeah. So if you're interested, feel free to check on our website. You can go to Slash.co and then go through HAK section, or send me an email, which I already sent on the chat box as well, at HAK@Slash.co. And then feel free to let me know if you're interested to get your pitch deck to be mocked by Dave. And then, I mean, like, this is always interesting, like having this kind of like a mocking session. Like, there's a lot of like feedback that you can get out of it. So I will really like encourage you to do one, so then like just improve and then get more feedback towards the pitch deck that you already
I mean, when they say practice makes perfect, it doesn't fit more appropriate than investor deck. There's people that's pitched 30, 40 times before they feel like they get it right. It's never perfect. So it's just something that you just do, but you learn a lot more when you pitch in front of somebody getting feedback, So it's just like when you do your deck and when you talk about the narrative flow, have someone go through it with you, a second eye, whether it's a family member or team member or something, because I'll sit there and go through a deck that I've created and I'll miss 5, 6 different things, and I might go through it 3 or 4 times just because I have this bias. It's hard to correct yourself. It's hard you're already in that thought. So it's really good and really helpful, these mock pitches, and I really enjoy them. So I look forward to it.
Yes, of course, me too. So yeah, feel free to check out our website for more of the upcoming events coming up from Slash and also HAK. Dave still have a couple of events coming up, 2 more events with Dave.
That's right.
So feel free to sign up. And then I guess that's it for today, right, Dave? So thank you so much for everyone who stick around until the end. It's a little bit overtime-ish, but I hope that you guys got all the knowledge. I mean, that's our intention in the beginning by creating this event, right? Like just sharing and giving giving back as well to the others and community. So thank you so much, everyone, for coming in, and hope to see you on the next event.
Thank you, Ans. Thank you, Dylan, for attending.
Yes,
and
thanks, Ans,
thank Maisman for me too.
Sure.
Thank her for me too.
Of course, I'm gonna share this later on to Mason anyway.
Okay, good.
Thanks, Dave.
Well, take care, everyone. Thank you.
Yes.
Hope to see you next 2 weeks.
Yes. Bye. Bye,
Bye.
Dave.